trading macro FX is a really effective way of trading the FX markets. However, there are some significant weaknesses in trading the markets from an FX perspective. And in this video, I'm going to look at a case study of the Reserve Bank of New Zealand and explain not only what that weakness is, but how you can potentially avoid some of its worst effects. In this video, I'm going to show you one of the most important lessons that you must understand if you're trading global macro FX. Now, trading global macro FX is a tried and tested methodology of trading markets, particularly as you look at differing interest rate differentials between central banks. Now, there is a saying also in the market that the market can stay irrational longer than you can stay solvent. And the recent moves in the New Zealand dollar, Japanese yen, and if you take a look at the blog, we've been highlighting the opportunity to upside in the New Zealand dollar, Japanese yen for pretty much since the start of the year. Now, looking at this pair, there's a really important lesson. And what I want to do is I want to draw your attention back here to the end of November. Now, if you look here around the end of November, you can see that the bond yield spread, which is the difference between the New Zealand 10-year and the Japanese 10-year bond yield, was pushing higher even as price was moving lower. Now, typically, you can see that price tracks the bond yield spread between the New Zealand and Japanese 10-year yields. Now, there came a point here around the end of November when the Reserve Bank of New Zealand met. Now, I just want to draw your attention to that monetary policy statement. In this monetary policy statement, and this is going back to November, they projected, due to the financial conditions in New Zealand, that interest rates would be rising to 2.5% in 2024 and 2% in 2023. Now, at the time, this was the most hawkish central bank out of all the G8 economies. So it was a very significant declaration by the Reserve Bank of New Zealand. Now, the Bank of Japan, by contrast, they are expected to keep interest rates low for the foreseeable future. And so there was this divergence opening up between the central bank policy of New Zealand and Japan. Now, I remember during one of the webinars that I regularly take, a question came in from someone saying, right, should we be buying New Zealand dollar yen right up, here at these sort of high levels? Because the difference between New Zealand's economy and Japan's economy is so great, wouldn't this be a good time to buy? And I think the question came in early November. And I remember at the time saying, be careful, because if you buy at the highs here, where do you have to put your stop to say you're wrong? And at the time, I said, you have to put your stop here underneath 74. Now, that turned out to be very sage advice, because you can see that the price moved, getting on towards 800 points lower before we saw the shoot higher in the pair, which is what we were expecting. And the point of this video, and the point that I was saying at the time, is instead look for areas where you can enter, but then exit. So for instance, at the time I said this overhead resistance, you could look to put a buy limit order there and just put your stops the other side. And now you see, it was around, there was another COVID surge towards the end of last year with I think it was the Omicron variant. And we saw bids come into the yen in risk-off trading, and so we had another leg lower. And then we saw this sort of, support line being tested. So instead of just entering and then having like an 800-point stop, it's far better to find key technical levels to enter and put your stop under those levels. And then if you get stopped out, then look for your next level lower. I mean, you could have looked at this overall sort of level and said, okay, that's a broad kind of support level. I'll be confident entering here because I can have my stop underneath 74. And then look, you've got, over 1,000 points upside. So it's far better to enter in little chunks than it is to have, one big position. And this is the danger, this is the key bit, is say you entered here with some leverage. You've only got to use a little bit of leverage, and then this drawdown
is a double-digit drawdown in your account with only just a little bit of leverage, just maybe 1 to 3, 1 to 2 even, and you're starting to get towards double-digit drawdowns in your account. And the problem with that is once you have those deep drawdowns, it then becomes much harder to think rationally. And also, you're more likely to go into denial. So say the Reserve Bank of New Zealand changed their policy and say they said, well, some conditions have changed, so we're not going to be looking at hiking interest rates as much as we thought in November. Then the bias for New Zealand dollar, Japanese yen upside could have dissipated. But if you are 700, 800 points, double-digit drawdown, you might think, I can't bear to take the loss. So don't underestimate how your psychology can change, and what would be rational suddenly becomes hard to attain because you can't think straight due to the position. Now, there is a psychological bias. It's something like, a buyer's bias. Once you've bought into a market, it's much harder to think rationally, and you're much more likely to hold on to the position because you don't want to sort of accept the loss. So I just thought this was a very helpful video to remind yourselves that when you have a clear macro bias, and you can see here, look, the bond yield spread was pushing higher, price was moving lower, we were expecting one to move up. The bias between RBNZ and the Bank of Japan was still very much favouring New Zealand dollar yen upside, and in the end, the macro fundamentals played out and were great. We had a decent profit on that trade. But you see, to that person who asked me that question way back in October, November, whenever it was, if they'd held there, yes, they would have been holding and they would have had a winning trade, but would they have held for 2-3 months through all that drawdown? Would have doubt got the better of them? Would they have, how would they have responded? So this is the weakness in trading global macro FX, is that sometimes markets can sort of behave not necessarily irrationally, but there can be other drivers, or sometimes there can just be a deep pullback and it's for other reasons. But eventually the underlying fundamentals come good, but make sure that you're using good solid technicals so you can take little small chunks where you can manage and define risk. I hope you found this video helpful. It will be helpful for anyone who's either starting to trade macro FX or maybe struggling with trading macro FX or struggling to manage risk. So please do give it a like, thumbs up, or a share. It will be much appreciated. And do attend some of my webinars where I go through key concepts like this every single webinar that I take.